And we're back. So, we're going to talk a little bit about the surge in foreclosures that, to be frank with you, gentlemen, our investment community has been predicting now since COVID began. That was going to be the great foreclosure surge that, to be frank, whether it's nice or not, investors are looking for. They're looking for distressed assets to rehabilitate and bring back into the marketplace. I'm wondering, Daren, you see this data, you talk to your servicers, the folks that are out there in the owner-occupied world servicing these loans. What are they telling you about this surge that has been coming down the road ever since COVID?
Yeah, and it was a surge that never happened, and I don't know that we see evidence that there's going to be a surge yet. But I definitely think there's been a shift in talking to servicers and how they talk about this. They're now becoming more bearish on this, and they're saying, yes, we are seeing the increase in delinquencies. We're getting calls from borrowers who aren't even delinquent yet, but they're anticipating being delinquent, things like that. And then the other piece that's shifted is that they're seeing less equity with these loans that are getting into trouble. And so there has been a shift in the way this we talk to servicers, but I don't think it's a big enough shift to say that that surge is finally coming. I think it's a more of a return to possibly normal levels of foreclosure activity.
Jeff, if you look at delinquent loans right now, the bulk of loans are performing historically well. If you look at conventional loans, the Fannie and Freddie loans that are out there, their delinquency rates overall are below 3%. It's something like 2.7% at the end of the first quarter. Where there are problem areas are in the FHA portfolio and in the VA, the Veterans Affairs portfolio. FHA has delinquency rates approaching 11%. VA has delinquency rates close to 5%. And Congress isn't doing VA borrowers any favors. They decided not to fund, but to cancel the VASP VASP program from the VA, which was sort of a last resort loss mitigation program for borrowers, where the VA would buy these loans from servicers and put the borrower into a 2.5% rate mortgage to help them maintain the property. That no longer has funding, and at the moment, there's no alternative for it, although Congress is trying to pass a bill with some other loss mitigation tools in it for the VA. Meanwhile, and Daren has talked about this, we talked about this in a prior segment, the FHA has had an almost ludicrously lenient program for loss mitigation. Daren actually once referred to it as the wash, rinse, spin cycle of loss mitigation, where people were using the FHA's partial claims program to take some of their equity, use that as a loan to bring their loan back to current status. That gets placed as a silent second on the back of their mortgage. And it was intended to be a one-time opportunity for people that got into temporary trouble. But borrowers and servicers were using this three, four, five times on the same loan, eating away at the borrower's equity, but also kind of artificially keeping them out of delinquency, out of foreclosure. So the FHA has changed the guidelines on that now, where you're only going to be able to do that once in 24 months. And that program kicks off in October. So these two pools of loans with high delinquency rates suddenly don't have the same kind of loss mitigation cushions that they had in the past. And I think that's where we're going to see a lot of the foreclosure activity coming from.
So, when we think about the reasons that there may be an anticipated increase, my guess is is a wide variety of reasons. What are some of the top, and I'll open this up to both you gentlemen. What are some of the top reasons that servicers are giving for why customers today are holding back on payments and ending up in default?
Yeah, I would say when we talk to servicers, number one is this exhausted loss mitigation. So borrowers are running out of options to avoid foreclosure. Um, that's number one. Number two is unemployment ticking up, and unemployment hasn't gone up a ton, but it's gone up enough to push some people over the edge. And then the third reason is kind of related to the first, but it's equity being drained. Homeowners who are in trouble are running out of some of the equity that they had a few years ago, and that's making them more susceptible to foreclosure. So those are the three biggest risks. And certainly VA is a great example of the first one, exhausted loss mitigation with that, and that was kind of the rug was pulled out from underneath VA borrowers very rapidly, which was unfortunate. But we definitely saw a corresponding uptick in VA foreclosure auctions, specifically in the first quarter. I believe they were up 104% year over year. Now it's just coming off of a very small level the year before, but that has real consequences.
Yeah, according to ICE Mortgage Technology's most recent report, there are 90,000 VA borrowers who are delinquent, and about 33,000 that are in foreclosure. And my guess is if we look back 4 months ago, we probably would see a fraction of those numbers because of the VA's moratorium that was in place and some of their loss mitigation options. The other thing we're seeing, Jeff, is the rising cost of home ownership in certain markets, that's being driven primarily by higher property taxes. In our prior segment, Daren talked about home prices going up 45-50% over the last few years. Well, property taxes rose in most states right along with those property values. So people that thought they had a fixed monthly housing payment are in a little bit of shock because those property taxes jumped, and they're even in more of a state of shock when they get their homeowner's insurance bill. Premiums have gone up about 24% nationally over the last few years. But if you're in a state like Texas or Florida or even parts of California, not unusual to see your insurance costs double on a year-over-year basis. And what that does for borrowers who were sort of on the margins, who just barely qualified financially for their mortgage, you're suddenly looking at hundreds of dollars more in monthly payments, thousands of more in annual payments. And some of these folks simply can't afford to make those payments and are either opting to sell the house or starting to miss on their mortgage payments.
Yeah, we're certainly seeing that on our side. Some of these costs, whether it be insurance, taxes, um, the DSCR loans, the rental loans, investors had a certain idea of what they were going to be able to have for expenses versus what they could rent these properties out for. And those numbers aren't always making sense anymore in certain markets, such as Texas, such as Florida, such as California, to a lesser degree. But Daren, before we get out of this segment, I must ask you, the auction.com platform is no better barometer for what's happening today in the disposition of assets. What's your data showing you on the single family market on your platform?
Well, what we're seeing is the volume trending slowly higher. So when we look at our foreclosure auction volume in April, it was up 11% year over year, and it was and we've seen several months now of year over year increases in that foreclosure auction volume. In the first quarter, we hit a 6 quarter high. Now, so that may sound that things are going up very quickly. However, if you to put it in context, we're still at 45% of our pre-pandemic levels. So we're still 55% below those pre-pandemic levels. But the numbers are definitely creeping up. We have seen that shift this year. And then REO volume similarly hit a 6 quarter high in the first quarter of this year, but still at 39% of pre-pandemic levels. So it's still about 60% below what it was back in 2019. And, Rick referred to this earlier, but that 2019 was still a pretty low level in terms of foreclosure volume. And we're still 60% below that level, but we are seeing the tide slowly rise.
And as a business model, my guess is you have predictions, how accurate they are, like any business.
Yeah.
It's a fickle business, right? How do you think about how the volume is going to either stay the same or increase? I can't imagine we're going
Well, we
down.
thought, we think it's going to increase. We're looking at probably a 5%, 5 to 10% increase this year over last year. Now, we were surprised last year. We were predicting volumes actually to be flat last year, and they actually went down in 2024, surprisingly. And so we definitely been surprised before, but there are some things that have changed that clearly indicate that the market has shifted. Delinquencies, seriously delinquent loans have ticked up higher for 2 quarters now on a year-over-year basis after being down for 13 consecutive quarters. So things like that point us to think that we will see a modest rise this year. And then depending on how the economy goes, and the housing market goes, we could see that continue, and the slope of that ramp up accelerate in 2026, but it's a little too early to say for sure beyond this year.
Well said. Thanks so much, gentlemen.